In this recording, we're going to continue on looking at the last key section of ratio analysis, looking at investment ratios. So remember, to date now in the live lecture, we've looked at profitability, we've looked at efficiency, we've looked at liquidity, and we have looked at gearing. So it's important that you understand the aspects of what each of those look at. How profitable a company is relative to its revenue, your margin calculations, and also how profitable you are relative to your capital, which we calculated return on capital employed. We then looked at how efficient the company was at managing its assets, and we looked particularly at working capital management. We then looked at the short-term cash position of the company, which we call liquidity, and we then looked at the longer-term solvency of a company, which we know as gearing. And the last one we left to cover in this recording then is from the shareholder perspective, that what does this company or business look like from an investment perspective? Now we're going to look at 4 key ratios here, but they're not the only ones that an investor will be interested in. They're of course going to be interested in profitability, they're going to be interested in liquidity, they're going to be interested in gearing, the debt position as well. But these are particular ones of interest to an investor. And that could be a current investor, or it could be a potential investor deciding whether to put money into this business or not. And these are some of the key metrics you will see when you look at, for example, a company's stats on Financial Times or Bloomberg or one of those financial websites. These are some of the key metrics that the investors in capital markets, those brokers, those analysts will look at to determine whether a company is a valuable investment or not. And so remember, if I buy a share in a company, and I can only buy a share in a listed company, which is a PLC is what we call it, a public limited company, I'm either going to get return on money through dividends, which is an annual payment that a company may pay, but they don't have to, or an increase in the share price. That's the only 2 ways I'm going to earn a return on my investment. So we're going to look at Alexis and we're going to calculate ratios for earnings per share, price earnings ratio, dividend per share, and dividend cover. Just to give us an example, there are other metrics, but we look at how they're reflected in the real world through a couple of companies using the Financial Times as well. So if we start off with the earnings per share, it's profit after tax, which is the profit available to shareholders over the number of ordinary shares in issue. So if you go back to Alexis, the profit after tax down here is 165 million and 11 million. Right? The number of shares, and this is where students can go wrong, the number of shares here, be careful, this share capital is 300 million pounds. Okay, so euros if we're talking about in Ireland. But you're told each share has a value of 50 cents. We call that the nominal value, i.e. what it's worth, the legal tender when it's initially launched. That's not its market value. We know its market value down here in the notes is 150 this year, 250 last year. So what we're saying here is actually each share has 50 cent nominal value. Kind of like the legal value that when they were originally issued, they were issued at 50 cent. That means we must have 600 million shares, because 600 million shares times 50 cent would get me 300 million euro. This is a euro figure, right? Not the number of shares. That would only be the number of shares if each share was worth £1 each. Each share here is all worth 50 pence, so you need double the amount of shares to get that amount of pounds or euros. So your earnings per share here then, EPS as it's called, we will look at 165 over 600, so it's a million in both, I'll just summarize the figures, and 11 million over 600 million. So the number of shares hasn't changed in either period. And this is a million on top, million on the bottom, so we can cancel them out, but you can do the full numbers out if you wish as well. So the earnings per share last year, 27.5 cents. The earnings per share this year has fallen significantly because we know profit has fallen, and it's now only 1.8 cent. So 0.018 of a euro. So significant fall in earnings per share year on year. And we know the main driver of that, your ordinary number of ordinary shares has not changed. You haven't issued new shares, nor have you bought back shares. What has changed is the fall in profitability. And that is a core metric. And actually, because it's so important, it actually has its own accounting standard. You don't need to know it in detail, but IAS 33, International Accounting Standard 33, just covers how to calculate that earnings per share, because that is quite important in the overall investor market, the stock market. It's a key metric. Just to show you 2 examples. So if you, for example, get a company and you just Google its name like Glanbia and Financial Times, it brings you up a summary page for Glanbia. Listed in the Irish Stock Exchange ISE. Its ticker is GL9. Price today is €10.45. Right, it's gone up 2.5% for today, and there's 374,000 shares traded today. So you can get a summary. You can get, for example, historical prices. So you can get a lot in this. This is all available free in the Financial Times. So you can get an idea of all the prices where the shares have gone from. There were €8 in November. They're gone up to €10 today. There's a good lot of trading, different aspects. If we go to the summary again, it gives you a summary graph. So you can see over 5 years. It gives an example. If it will load. This is not loading for, it's only loading for a number of months. But you can actually look at the summary graph of where it's gone over the period. Quite low around September, October, but it's jumped up again from 8 up to €10 a share. And you get all the news and announcements of shares as well. You can see what happened here. The reason that there's a big boost in the share price today, 8 hours ago, Glanbia announced transaction in its own shares. So what it's actually announced is going buying back some of its own shares, which will give a bit of boost to confidence to the market, and therefore there will be a boost to the share price. So it's a nice summary in the Financial Times. You can actually see the news that goes on and the key events. What we're in is look at the key statistics. It tells me all the different share prices. So it closed yesterday at €10.19. The high today at €10.54. It's currently trading around €10.44, €10.48. So it's in around €10.40 today. Its earnings per share currently is 51 cents. So based on the current earnings per share are 51 cents, but people are willing to pay €10 for the share. This TTM is the trailing 12-month earnings per share. So they take the most recent 4 quarters of results and they add those together. That's the earnings per share that they use. So it's a key metric, EPS. Same for Tesco, if you look at the same thing. Tesco's earnings per share, about 10 pence. So 0.1 of Great British Pound is 10 pence. GBX is Great British Pence. Just be careful, GBP is pound, GBX is the pence. So it's currently trading there at £2.29, and they have earnings per share of 10 cents. So we're getting an idea of, well, the earnings per share, but people are willing to pay a lot more for that for a share in the company. And there's a different metric you can look at for that. So if you Google any name, for example here, Ryanair and Financial Times, just go to their name, Financial Holdings Summary, and you can see that gives you the exact same information. Ryanair are up 2% again today, so good story in the markets. And we can see down here, their earnings per share, they've actually made a loss. So it's a negative figure, because if you have negative figures, that's of course a loss. But people are still willing to pay for shares in the company. They're willing to pay about €16 for a share in Ryanair. So that's your first key metric, is what is the earnings per share? The second key metric relates the earnings per share to the share price. So it's called the price earnings, or the PE ratio. Now this is essentially saying, what multiple of earnings are people willing to pay for a share in this company? So is the company trading at 10 times earnings or 20 times earnings? And this is the way a company is actually valued as well, as a multiple of earnings. So you take the market price per share and divide it by the earnings per share. So for example here, the PE ratio in 2011, we're told the share price in the question for Alexis. The share price here was €2.50 in 2011, €1.50 2012. So you take the 250 and you put it over the earnings per share for 2011. So the price earnings ratio there was 9.1 times. That's how we'd say it there. It's in times. So people were willing to pay 9 times earnings for one share in that company. So it is indicative of how much confidence investors have in a share as well. Whereas this year, they're willing to pay €1.50 and the earnings per share is 0.018. It's actually gone up to 83 times. And this is the danger, is where students will misinterpret what's going on here. So your price earnings ratio has gone from 9 up to 83. At a high level, an average student would say that means people are willing to pay a lot more for the shares compared to the earnings. So it must be bigger confidence in the market. It's more likely because if you think about it, the share price embodies what the future prospects of the business are. This is where people think the company is going. So it's future oriented. and it includes information about where people think the company is going in the future. The earnings per share, that's a historic figure. And what we can get an indication is here, the investors do not think the normal earnings per share will be 1.8 cent. So they haven't dropped the share price the same extent as profits have dropped. They think this may be a one-off or certainly an abnormal year because of this temporary blip, because of the new warehouse and the massive increase in headcount. It will take a while to get it right. So realistically, they may think, for example, well, hold on, I know last year we were paying 9 times earnings. I know earnings has fallen a lot, but maybe I don't expect it to be 18 cent next year. I might expect it to be maybe 15 cent next year. So if it was 15 cent next year, 1.5 over 0.15, that would be 10 times. So watch your interpretation of what price earnings means. In normal run rate businesses, you can see it as movements about confidence or pessimism in a business. But when you have artificially low figures, and a good example of this, go back and look at the PE ratios around 2008, 2009, 2010. Those PE ratios for companies were astronomically high. Why? Because companies had one-off very low figures because of the financial crisis, very low profit figures, and people knew this was a one-off item. So they didn't hammer the share price that much. Yes, the share price fell, but it didn't fall as much as the earnings per share figure. So people were realistic to say, hold on, it's not as bad as this, they will turn it around, and we'll embody that in the share price. But the PE ratio can be seen as a kind of mark of confidence, and it can be used to value a company. So if you look at, for example, here, the price earnings ratio of Ryanair, you can't have one. Why? Because it's loss making. So take that to extreme. You're saying, why would anyone pay any multiple of profits if it's a loss? Surely someone should be giving you money to take a company like that. It's because this is future looking. They're saying that loss is a one-off. We know Ryanair are going to be profitable in the future, so we're willing to pay €16 for a share today, even though it's loss making. This is historic focused. This is future focused. You can get unusual ones. If you go, for example, Facebook, Financial Times, and we go, for example, I think Just Eat as well. Just Eat, Financial Times. Just to give you an example of other ones, just to show you different ones. I don't think Just Eat. Let's see here if it is. So your Facebook is an example. Facebook, $8.43 earnings per share. They're trading at 34 times earnings. So even though they're only earning $8 a share in earnings, people are willing to pay $280 for a share. So you have to get an idea here, watch, why are people willing to pay so much? Because it's based on future growth. You get in now because you expect that earnings figure to be higher in the future. Same with Just Eat. Just Eat are loss making, but people are still willing to pay for shares. So you have to be able to interpret it. That doesn't make sense if you just look at PE ratio in a very mathematical perspective. PE embodies, or the market share price embodies where they think it's going in the future. And you could easily get a PE ratio of 1,000 times if there was something unusual going on in the business. So be careful when you're interpreting it, unless it's a mature business. If you have some unusual earning movements or you have something unusual going on, you can easily get an unusual PE ratio. So it must be interpreted with care. The likes of Tesco. Tesco's PE ratio currently trading at 21 times earnings. Glanbia trading at 20 times. But you must compare like with like. So to make sense, for example, to compare Tesco's PE ratio to something like, I think Morrison's Financial Times. There's Morrison's, because they're a supermarket company as well, or Walmart. Makes sense to compare those. Morrison's trading 16.5 times. Tesco's trading 21 times. So it looks like people have a better confidence in Tesco than they have in Morrison's. You could compare, for example, Glanbia, you might compare that with Kerry Group, and you might compare Ryanair, for example, you'd compare that if it had a PE ratio, and it would have in previous years when it was profitable, compare that to a company like EasyJet or IAG. So it's a like for like comparisons is the big thing. But PE ratio is a very important metric because a lot of analysts use it to see is a company overvalued if its PE ratio is too high, or is a company undervalued if its PE ratio is too low. I know some people will say if this is a live webinar, what's an average one? There's no such thing as an average overall. Now you can look at it, for example, if we look at the FTSE 100 PE ratios, to give you an example. So what's the PE ratio of the overall one? So you're taking all the FTSE 100 companies, all their values divided by all their earnings is about 20. So the average ratio is 20, and it went up a minimum of 7, maximum up to 34. Right? So it just depends the timing, what was the average overall, where you take them in totals. But it can be a useful one looking at each of the components of, so for example, FTSE 100 component PE ratios. So there's plenty of things you can look around here to see, does it give us by share? So it mightn't give us the actual listing. Just double check if it gives us this one here. But the key point here is you're looking for is the PE ratio. See, it gives you different dates that the PE ratio around 14, 15, 16, 17 times, can be as high as 33, can be as low as 15, 13, depending on what you're looking for, depending on what's happening in the markets and how earnings are going for companies, you can have different PE ratios. So this is looks at it here, the PE ratios you're going along. So you can see it moves up and down depending on the type of year, depending on whether you're in a financial crisis or not. And you can get unusual ones. So it's something to be interested in because it's often very much observed closely by investors and by people who follow the stock markets because it gives you an indication of market confidence or market pessimism. But again, as the example with Alexis, you must make sure you interpret it carefully. Dividend per share, as the name suggests, is the normal dividend paid per share per year. This gives us an indication if this company is a dividend payer and how much you might expect from regular dividends or regular income. So we're told in the Alexis example, they paid 40 million both years. So 40 million dividends both years. So we call this DPS, dividend per share. It's actually the same calculation both years. 40 over 600 and 40 over 600. Both of them are millions. So you're getting 6.66 cent per share. That is the dividend per share for both companies. Now that is a hugely important one for a lot of businesses because some businesses are known as what's called income stocks, that they will pay a regular income to their shareholders. So they're known for paying dividend and they attract investors like pensioners and like pension funds because that's what that investor wants, regular income. Other companies, the likes of Ryanair, they don't pay a regular dividend because they don't have the funds or they're not sure the industry they're in might be too cyclical. So for example, if we look here, Glanbia is well known as a regular dividend payer. They pay an annual dividend of about 26 cents per year currently. Right? If you go to, for example, Tesco pays a regular dividend, 9 pence per year. But if you go to Ryanair, no information on dividends because they don't pay any. Because Michael O'Leary and all them argue that they don't want to attract investors who are looking for regular dividends. Because of the cyclical nature of the industry, they wouldn't be able to guarantee a regular dividend every year. Same at Facebook, they don't pay a dividend because they're high growth. Investors are in Facebook to grow the share price. Same at Just Eat, they don't have money. They're plowing money into the business. They don't have money to pay out as dividends. So dividend policy is hugely important. And a lot of shareholders found out that the hard way when you think of what happened with Bank of Ireland and AIB in the financial crisis. They had to cut their dividend. And one big demographic of shareholders were pensioners because they were using those shares to supplement their pension income. They were relying on the high dividends being paid by those banks. So dividend policy is a huge area. And if you are interested in that, have a look at all the headlines in Financial Times, dividend policy and COVID. There was huge changes about COVID where a lot of companies had to cut down dividends, sparked a dividend drought for investors because they had no cash. The banks had to cut dividends because the regulator told them to hold the money. We don't know what's going to happen. And a lot of companies just had to pull the plug because they couldn't know where the cash is coming from. So remember, dividends are optional. You don't have to pay them. But if you look at for a company like Glanbia, dividend history, they are one exemplar of a very steady dividend history year on year. So they have a steady growth, they know what to expect. So if you look at their dividends, for example, the dividend history even from 2011 to 2019, slow and steady growth every year. From 8 cents a share up to the 26.62 that I just showed you there, 26.62 cent. Another one would be Kerry Group, is known for steady, consistent dividend every year. And that's a very important area in corporate finance called dividend policy. But of course, the dividends are reflected in the financial statements as well. All right. So we're saying here we have a consistent dividend each year, and we already questioned that. Why would they pay the 40 million dividend in 2012? Because they're essentially financing it. When you look at Alexa's statement of cash flows, they're financing that dividend payment out of the overdraft because they don't have cash to pay. So if that profitability is continuing to be declined like that, you question whether they can continue to pay that dividend. And one very useful metric to look at the sustainability of dividend is this thing called dividend cover. So you look at the multiple of dividends that are available in profits. It's very similar to what we looked at in the live webinar, interest cover. How much cover is there to pay the interest? Now we're looking at how much cover is there to pay your dividends. You do profit after tax. Now technically you take off preference dividend as well, but in this instance you won't have any. So don't worry too much about it. And divided by ordinary dividends. So in Alexa's example, the dividend cover in 2011 would have been 165 over 40. The profit after tax over the dividend. So you had 4 times profit, 4 times dividend available in profit. So you have plenty of cover there to afford your dividends. But the big problem this year, and we flagged this already, you actually don't even cover your dividends in this year's profits. So what you're doing is you're paying out from previous years. You've only a cover of 0.275. So you haven't even 1 times cover. So it doesn't look like this level of dividend payment is sustainable if the profits don't recover. And that's something that's of very interest to shareholders because they know, like what happened in COVID, if your dividend plummets, or if your profit plummets, should I say, dividends are most likely going to be cut. So dividend cover gives you a measure of the sustainability of this dividend payment, which will be interesting to a lot of shareholders. So if you come back and look at Glanbia, they don't give a dividend cover here, but they give a dividend yield. So there's no dividend cover there. So it's not a key metric that's given out. So no. So we'll just look at, for example, Glanbia dividend cover. Do they give it out as anyone? No, so they don't give that as a key metric. It's only dividend yield. Dividend yield is essentially looking at dividend divided by the market price. It's kind of showing you if you buy a share in Glanbia today, for example, for €10, and you get 26 cents this year, you're getting a dividend yield of about 2.55 cents. So it's like your annual return on your investment. If I buy a share for 10.44, I get 26 cents each year. I'm getting a return in annual income of 2.5%. In Tesco, the dividend yield is 4%. So it's a higher paying income stock because it's paying more of its percentage back each year. And that can vary depending on the industry and depending on the current market movements. So that's the end of the key ratios. This Excel file will go up on loop, so make sure you take a look at it and practice. You have to be able to, number one, do your calculations, but the second thing, of course, is to be able to interpret. Is higher better, is lower better, and what does this actually mean? So you need to understand the significance of the ratios, not just the calculations. But I'll give you another couple of worked examples in your question pack and also through online videos. So just to wrap up then, there's another key one you might have a look at. You might see it come across as sometimes it's called enterprise value. That's the value of debt plus equity in a company. So sometimes in corporate finance, we value a company as a multiple of EBITDA. So you do enterprise value divided by EBITDA. So it's just something in case you come across it. You won't come across it in an exam, but if you wanted to buy the company outright, you would have to buy its shares, i.e. buy its market value of the shares, which is known as the market capitalization. So you can see that here for Glanbia. The market capitalization is 3 billion. Its shares, the number of shares it has, times the share price. That's the market value of equity. If you wanted to buy out the company, you'd have to buy out the debt, and then any cash that's in the business you get. So that's why we take off that. So it's often called the market value of equity plus net debt. Net debt being debt less any cash on the business. Because if you take over the business, you own that cash. So just bear in mind, there can be interchangeable. I think that might have caught some students out. We can call it sales. But that can also be called turnover or revenue. Inventory, which is the current asset, can also be called stock. Debtors can be called trade receivables. Creditors can be called trade payables. So particularly as we move towards international accounting standards, we get a bit more standardization of the terms. But sometimes when you're looking at different textbooks or different terminologies, you may be caught out by one or two items. And don't be afraid to ask me if you're not sure what an item is. Sometimes those terms can be used interchangeably. Right? So ratio analysis itself, it is very useful. Right? It gives us these key metrics that can be used across businesses to compare performance. So we can look at profit relative to sales. We can look at how much assets we have relative to our liabilities. So it allows comparisons and benchmarking. Right? But the key point to remember ratios is it only highlights the issues. Right? It's not going to solve the issues. And a ratio in isolation, it's very little value. A ratio must be put in context. So what was it last year? What are the industry average? What is our competitor trading at? Right? And remember, rubbish in, rubbish out. That if you have poor accounting numbers because they're fraudulent or they're prepared under bad assumptions, then you're going to have poor ratios. So if you're not comparing companies with same accounting policies, or if you're not comparing companies that are prepared the same way, you're going to end up with meaningless ratios and meaningless insight. So that whole phrase garbage in but garbage out is important. Good ratios are relying on good financial statements. Right? So we talked about that in terms of it is powerful, but it has its limitations. You can either compare time series, so comparing trends over time to see is this company doing well, is it improving with the economy or is it disimproving? Or you can compare it as a cross section, so take at a point in time, compare it to what was the budget profit margin for the year? What was our profit margin of our competitors, our industry averages? So this is comparing at a point in time. You're benchmarking against other aspects. This is comparing over a period of time. You're looking at your trends as well. Right? So when you're looking at exam questions, so this is on nearly every single paper, first thing is to figure out why are you doing the analysis. So it can vary from question to question. Some years you'll be asked to analyze from a bank's perspective. You might be asked to analyze a company from a supplier's perspective, from an investor's perspective. First thing you do before you jump into the ratios is look at the financial statements. Where's the profit gone? Is the company growing or declining? Where's the debt going? Where's the cash going? And that's exactly what we did with Alexis as well. You get an idea of the eyeball test, high level movements, and then you go in and you look at the ratios. But remember, part of the ratios is calculation. The rest of it, you must build a story. That is using the narrative in the question, like we did with Alexis with all this narrative here, using the financial statements, like we did at the start, and then using the ratios as well. So it's like you're triangulating all your information to see can you build up a story and come up with some justified recommendations. Right? So ratios is quite useful. Like business valuations, we can value a business using price earnings ratio. Right? Banks will use, they look at proposals from companies, they look at their margins, they look at their gearing ratios, they look at their interest cover. So these key performance indicators, they can be used right across different stakeholders to value a business, to invest in a business, to determine whether it's a good prospect to lend money. So the key point is this is a hugely important skill set. You have to be able to read and analyze financial performance of a business. What does a set of financial statements look like? What is it telling you? Now, we don't expect you to be able to prepare them, right? You're not going to be a qualified accountant after this course, but we want you to have that confidence to dig deeper. Say, that margin looks off. Or what's your liquidity ratio? What's our gearing ratio? So you have the confidence to ask those types of questions and maybe ask the accountant for more information. Show me a statement of cash flows. Show me a statement of financial position. Because you know what these things are now and you know where they can be beneficial. But the key thing remember as well is you know their limitations. Ratios alone are limited value and they can be misinterpreted. Like I showed you with the price earnings ratio, you must understand where it's coming from. What is driving the changes? Don't just blindly rely on something and take it as a given. So that's the finish now of section 5, and we'll wrap up this next week in class as well. You need to know the financial accounting, what is it, and why is regulation so important. You need to know what is in the financial statements, what are the 3 key financial statements, and what do they look like, and you need to be able to analyze them, which we call ratio analysis. All right. So we'll pick up that and we'll wrap it up next week in terms of the final week. Have a look between now and then. The full video of Alexis is available if you want to go back over it again. And there is a full question pack up there on ratio analysis as well. So you have plenty of material available, and there'll be a lot of past exam questions available from next week onwards with walkthroughs that you can get a good idea of the style and structure of a question that could appear on your exam in January. So that's finished it off, the Alexis example, and we will finish off section 5 and discuss any questions you have in the live webinar next week. Thank you very much.